We're joined by Robert Hagstrom. He's Legg Mason's Capital Senior Vice President and also the fund manager there. Robert, also author of The Warren Buffett Way. Robert, always great to have you in the loop, of course. And
good morning.
I want to get your take on this wager and this whole idea between index and active investing. I mean, where do you land on this?
Well, two things. I think Dominic said it so very well. Even in a level playing field, competing against those high fees is going to be challenging, as Dominic said. But I think you see the genius of Warren Buffett, that mathematical mind working so brilliantly at the end of '08. When you know that at the end of '08, it was the worst 10-year period, lagging 10-year period for the S&P 500 since the Great Depression. And if you went back and looked at those lagging periods, anytime you've had 10-year periods that were so bad, what you know is the next 10 years are pretty good. So I think the wind is at his back. And as Dominic said, the hedge funds have got the wind in their face with the high fees.
Well, I mean, Robert, one of the things that we talk about so often is whether or not mathematically, yes, it might be a good wager here, but there's got to be a reason why this hedge fund of hedge fund industry, the fund of funds business, is still pretty much intact. There's got to be a reason why they can still generate outsized returns, or is there? Is there an argument there against them?
Well, we're going to see. You know, Dominic, one of the things that you and I have talked about is that hedge funds typically are going to do well when markets are sloppy or markets are sideways to negative because they have part of their portfolio hedged for the downside. So they pick up excess return in down markets. It'll be interesting to see how well hedge funds do if, in fact, we're in a period of sustainable higher returns in the stock market. Being short is a problem for them. An index fund that isn't short will not have that same wind in their face. That we know.
Okay, Robert, just hang on with us because I know we're going to have you back right after this break. I want to talk more about Berkshire Hathaway and Warren Buffett. There's a column out on Bloomberg from Alice Schroeder talking about how Berkshire shares are struggling right now. And actually, we have a bit more time than I thought. So, in fact, Robert, let me just toss you a first question out about that. You know, Alice was saying that Berkshire shares are struggling right now, and that, in fact, it's basically priced at below its liquidation price, and that the stock and that basically investors are placing no value on Berkshire. I mean, what do you say to that?
Well, the stock is cheap, Betty. There's no doubt about it. Alice got that part right. It's trading near book value, which would imply it's earning just a cost of capital. She also rightly pointed out that the market's giving it no benefit for future growth. So if you think that the businesses that Berkshire Hathaway owns, in addition to the portfolio that it has 0% chance of growing in the future, then the market's got it right. I don't think that's the right call. I think Berkshire's undervalued, and I think it's going to do extremely well going forward as it grows, both its internal businesses of Berkshire Hathaway plus the outstanding stocks that it has. So I would take the bull case on that.
Now, Robert, not to belabor, all this talk about Buffett, but I do want to quote one more comment from Alice Schroeder's piece on Berkshire Hathaway, which I have to say was quite critical about his investing acumen these days. She says, quote, Buffett's investing record has been underwhelming for the past few years, except for special opportunities linked to his own reputation and relationships. And she says that should be a point of concern for investors. She's talking about the Goldman Sachs, for instance, investment. What do you say to that?
Well, she's not untruthful. If you look at the last 3 years, Berkshire Hathaway has underperformed the market. What I would argue, though, is if you look at the longer-term track record, and let's talk about the short-term track record in a second, but if you look at the 5-year record, having taken you through the financial crisis, he's head of the S&P 500. If you take the 10-year record, he's up 51% versus the S&P up 33%. And if you want to go back to 1999, go through 2 bear markets, a financial crisis, the real estate crisis, he's up 76%. And the S&P's down 9. So the long-term record, I think, is very solid. Alice has picked 3 years, the last 3 years, coming off the bottom, and then Berkshire Hathaway stock has underperformed the S&P 500. I think you have to keep in mind that Berkshire will always underperform fast-rising markets. It has a beta of 0.65. That's going to make it very hard to leapfrog a fast-rising market.
Yeah.
So I understand where she's coming from, though, but I think she could have extended the argument more into a long-term track record versus what's happened in the last 3 years.
Right, just this one pointed period of time in 3 years. Let me just broaden this out a little bit, Robert, because I know that in your fund you hold a big chunk of Apple, and something actually Alice talked about, which is share buybacks for Berkshire. She says he didn't do it in time. Apple has now done that earlier this week, saying that they're buying back shares and they're issuing this dividend. As a shareholder, what's your take on that?
Well, we're very pleased. We would have liked more, and I think more people are saying that they could have been a little bit more aggressive on the dividend. They could have been a little bit more aggressive on the share repurchase plan. But we now got them in the game. They now are paying a dividend. They now are buying back stock. That's a great first signal. Now we'll just see as this continues going forward. Let's just see how aggressive they're able to fund that share repurchase program with the cash flow that they're generating at the company.
Robert, do you imagine that Apple, by taking this maybe smaller first step than people had thought, is setting itself up for perhaps growing that dividend in a much more consistent fashion over time? We know a lot of value investors like yourself appreciate seeing consistent dividend growth over time, right?
You know, Dominic, I think that's exactly right. I think they've got their toe in the water. They're in the water now. I think now what you want to see is a more consistent message that comes about how they're going to allocate the capital to the dividend and the share repurchase. By way of example, one of the best performing big cap legacy tech stocks since the 1999 period, the only one that's hit its all-time high, is IBM. A stock that Buffett bought late, he would admit. IBM basically has had tremendous performance because it has told shareholders what its dividend policy will be, what its share repurchase program is going to be. It's been aggressive. They funded it. People that own IBM know what to expect. If you get that same kind of mentality going at Apple, I think you could see the stock much, much higher over the next several years.
And I know, Robert, just more broadly, you think the market's going to be higher December 31st than it is now. I'd be interested to know, what are the major risks that you see to that call?
Yeah, Dominic, you and I talked about this yesterday. It's always the macro risk in my mind. I think why we're doing so well this year is that the headline risk is not forcing us into the risk-off, risk-on trade back and forth. You know, we just got a slingshot back and forth last year with everything that was going on. This year, the macro news seems to be very quiet.
Yeah.
We've gotten through Europe. We've gotten through the Middle East. Things seem to be doing well. And now the fundamentals of the market are starting to get the headline. And that is telling us that stocks are cheap relative to bonds. And so I'm not surprised to see the market moving higher. I think it grinds higher. I wouldn't be surprised if we had a pause, a little pullback that would be healthy. But Dominic, I'm still on for a cup of coffee with you. December 31st, the stock market's higher than it is here.
Okay, we snuck in Josh and on you too, Robert.
But I'll take you up on that. I'll take you up on that bet, Robert. I'm there. I'm there.
Robert, thank you. Robert Hagstrom,
Good.
The Senior Vice President and Fund Manager at Legg Mason.